Hey everybody, this is Derek here from the Dividend Talk podcast. This is part 3 of our chat with Bob Lai of Tawcan.com, who talks about his journey as a dividend growth investor from a Canadian perspective. This part of the episode is all the questions from the community which Bob kindly answered. Check it out and I'll see you on the inside. Cool. We might move on then to some questions from our community. The first one's from Jeremy. He loves your stuff, following your blog for quite a while. He wants to know, if you were able to start dividend investing all over again, what would you do differently, knowing what you know now?
Yeah, first of all, thanks for the support, Jeremy. I would avoid falling into the dividend yield trap, right? And actually understand the companies more. When I first started investing, definitely investing a lot of high yield stuff that are not, just doesn't make any sense. And obviously the dividends get cut and learning hard way. So I would do it differently. And also listen to my guts a little bit more. Like, I missed the opportunity to invest Apple when iPhone came out. I actually, like a few weeks after iPhone was announced, a coworker of mine got his hand on an iPhone, and I got to play around with it. And we both thought I was like amazing. And we even joked about, oh, we should invest in Apple, but never did until later and kind of missed the opportunity, right? So kind of listen to your intuition a little bit more. I think that would be a lesson I would do differently.
Cool, good answer. Nakil has asked, what is your opinion on ticker symbol CNQ? I think it's a Canadian Natural Resources stock.
Yeah, they're the Canadian Natural Resources, a pretty big company in Canada. They, it's a oil producing company. We own it. It tanked quite a bit during early on during COVID, because obviously nobody was using oil, so the company suffered quite a bit. But now it's pretty high. With energy stocks, it's quite cyclical. So if you do, grow your portfolio to a higher percentage in energy stock, just be mindful that they're cyclical, right? So it could be high for a few years and then could be low for a few years. Just depends on the war economics. But generally speaking, I think it's a solid company. Just depends on your entry point.
Nice. Jacob has asked, he can't seem to find your portfolio on your website. I don't know if you publish it, but maybe you could give us your top 5 positions.
Yeah, it's actually under, I have a link on under my menu. It's called Dividend Income, Dividend Portfolio. So I list all of our holdings there. So top 5 would be, I don't track it every day, but it's basically iShare X Canada International ETF, TD, Royal Bank, Apple. I think it's either between Enbridge or National Bank at this point.
So Bob, about Enbridge, right? I've been looking at it several times. I'm just wondering, like, something is stopping me, and I think it's because of the high yield here that kind of pushes me away from the stock. But what is, in your opinion, kind of the bull case, or why do you own it?
Yeah, Enbridge is interesting, right? So if you look at it from a payout ratio point of view, it's over 100%. But Enbridge is kind of unique in the sense that you kind of have to treat it as a utility company in some sense, and you really need to look at the adjusted FFO and also the free cash flow to figure out their dividend safety. I think for the most part, their dividends are safe, and they've been raising dividends pretty consistently. Right now, my case for Enbridge is that if you look at the Enbridge business, what do? They transport crude oil and natural gas across North America. what do people use primarily to heat their houses in North America? Natural gas, or I guess crude oil for energy producing as well, right? And that's not going away anytime soon, right? What's one thing that the Europeans are kind of suffering right now? The high energy prices. I heard all about it when I was in Denmark.
Definitely.
how only government owned properties are turning down the heat to like I think 18 or 19 degrees, and people are cold working in there, and lots of discussion on that, and how people are turning off flies, and apparently there's like a 30% reduction in energy consumption or something. Anyways, so with Enbridge, I think just because the North Americans use natural gas to heat their home, there's a need there. If you look at from a macro point of view, what's one thing you have read in news in the last few years? These new pipeline projects keep getting rejected because environmental concerns, or mostly environmental concerns, because there's a lot of protests. So what does that mean to the existing Enbridge pipelines, their pipeline networks? All of a sudden, that network becomes more valuable than ever because you can't build new pipeline networks anymore, right? So what you're seeing in this pipeline industry is these big companies taking over, like acquiring these smaller companies, right? So for example, Inter Pipeline a few years ago got acquired by Brookfield, right? Because their share price tanked, and then Brookfield, they saw that as an opportunity to sort of doing a hostile takeover. So they did that. So you're seeing a lot of these companies starting gobbling up smaller ones. So that's my bold take. Now, would this change in the next 10, 20 years? Possibly, because as we shift away from carbon resources to renewable, I think that might change. But Enbridge is also changing their way to operating as well. They're now starting to invest in more renewable energy assets as well. So the company is going to evolve over time.
Okay, thank you.
No problem.
Nice one. Ron has asked if you could comment on ticker symbol OTX, and I think they are Open Text Corporation.
I don't follow them too closely personally. They're every time, kind of like Novo Nordisk. Every time we looked at it, we're like, oh, it looks nice, but there are other opportunities for investing our money elsewhere, right? I think I would categorize them as lower dividend yield but very high dividend growth. Just looking at some numbers here. Give me a second. I think they have raised dividends pretty consistently over the last few years. The yield is about 2 in the mid 2, so it's attractive enough. But again, if you're looking for yields, 2.5% may not be that attractive to some investor, right? But the high growth is interesting. So it has a 10-year dividend growth streak, a 5-year dividend growth rate of 12.7%. So it's a decent growth. But again, like, will I own it over the Canadian banks? Probably not at this point. I don't know. I just think there are other better companies to invest than OpenText at this point for us. Now it could be different for this listener, right?
Yeah, and on top of that, I find their products not exciting enough to own a piece of their business. That's maybe also a good one. I think most people hate their products as an employee in a corporate because it's all about finding documents that you don't find, or you get chased by the record management department to do the version updates. So it's bad affinity.
You kind of have to also need to understand what the company does, and you need to be able to be excited about the company in some sense, right? Like I'm a really big believer in Apple, right? I could go on and on about Apple, but if you think about it, like why is Apple so good? It comes down to its ecosystem, right? How many people do you know has an iPhone and other Apple products, right? I know quite a few, and I actually know quite a few people that used to own an iPhone, switch to an Android phone, and then a few months later switch back because they can't get away from iMessages, right?
Yeah.
And then if you look at the whole Apple Silicon, one thing I noticed, if you look at their latest releases, except for Mac Pro, all their computers and laptops are not user upgradable anymore. So when you, as a consumer, this sucks as a consumer because you have to invest so much money for your brand new laptop or computer or desktop. But as a shareholder, it's great because what Apple is forcing consumers to do is you have to make that initial investment of, you need to upgrade your RAM, you need to upgrade your hard drive or flash drive, and making, because everything is integrated now, right? You can't just open up the laptop or computer and put your extra RAM or upgrade your hard drive anymore. You have to make that decision now, and Apple is charging an arm and a leg for these upgrades.
Yeah.
So from a shareholder point of view, I'm like, this is great,
Exactly.
But wait till I need a computer. I'll complain a lot about this business model.
Yeah.
When it eats your dividend income.
Yeah.
Nice one. Bart has asked you about Qualcomm, ticker symbol QCOM. What's your thoughts about the company and its fair value?
Yeah, so we got in Qualcomm quite early. We're actually doing pretty well with Qualcomm. We got in Qualcomm in the low 60s. I share my dividend portfolio, like in terms of what we own, but I don't actually share the cost basis just for privacy reasons. And we don't share how many shares we hold, just again, because my name's out there. Actually, in fact, a lot of my coworkers read my blog, so I'm like, need to be careful what I share in terms of numbers, right? And my friends read about it too. Qualcomm, if you research a little bit about this company, you'll know that they're in the cellular world. They own the 5G technology or 5G world right now. Sure, there's MediaTek, but they're not now at where Qualcomm is. I know the cellular business pretty well because that's basically what I do for work. Qualcomm has tremendous amount of IP on cellular technology. So, just because Apple buys Qualcomm chips, it's not just the chip, they also have to pay royalty to Qualcomm, and that's like insane amount of money they're earning from the royalties, right? Qualcomm has expanded into they have this Snapdragon processor world. It's picking up. They're also recently at CES, they also came out with a bunch of news about cars. They're now investing heavily into the auto industry, like the infotainment system and the like self-driving technology. Am I bullish on Qualcomm? Yes and no. I think with any technology company, especially hardware centric, there's also always a risk of people overtaking you. Just look at Intel, right? Intel for the longest time was like the leading example of a chip semiconductor company, and they kind of have fallen behind, and they're suffering right now, right? Qualcomm could be there next if they don't continue innovating. But for now, we own Qualcomm. It's a very small percentage of our portfolio, and we plan to continue holding it. Now, I think the listener's question is it a fair value at this point? I'm just going to look it up here. Now at $123 at a P ratio of 10.76, I would say yes. I don't know what their historical P ratio is like at this point. At 2.44% yield rate, that seems pretty decent in my opinion. Now, if I just look at the U.S. dividends champion spreadsheet, that's a very nice spreadsheet for any dividend investor. Just looking at QCOM, they have raised dividends for 20 straight years. At a 10-year dividend growth rate of just under 12%. Payout ratio is pretty normal. Yeah, I would say it's at a fair value at a P ratio of 10 point in the mid tens for a technology company. I think that's pretty fair.
Cool. That seems fair. Dividend Yogi has asked a question for maybe both of you. What's on your shopping list in the near future?
I'll start. I started looking at Ahold Delhaize a little bit again. Just wanted to reassess like what the business is worth. It's in my top 5, but I still feel I have too little of it. So Bob Ahold Delhaize is also owning Food Lion in the US. They have their revenue is 60% US and 40% mainly Netherlands and Belgium. So it's kind of the / target of the Netherlands.
Yeah.
That's one. And then second, I'm still looking a bit at Texas Instruments at the moment, but I haven't made up my mind yet.
Yeah, I think I tweeted out the other day, we just dumped $30,000 on the shopping spree, and we actually added a bit more in the last few days, or we're up about 40,000 investors so far in January. And listen, might be like, oh, you must make like tons of money. That's not the case. What we do, we save money. Last year, because our tax advantage accounts, we transfer a bunch of money early in January and then try to max out our RSP as early as we can. So usually if you look at our buying trend, is that we buy a lot of dividend stocks in the first half of the year, and then we kind of slow down a bit in the second half. So that's exactly what we're doing. We just dumped about $40,000 in the market. What did I buy? I bought Brookfield Asset Management Company. That's just a new spin-off from the Brookfield. So Brookfield is like kind of like, you could call it like a holding company. They own like these umbrella companies underneath, and the way it was structured, it was never very truly valued. So they spun out the asset owning company and try to do a little bit higher yield. So I thought that's a good opportunity. We also got into CIBC, like the Canadian banks, right? CIBC, National Bank, TD, Royal Bank. We bought a bunch of them. The banks are kind of suffering right now. It has picked up since late last year, but I think the valuation is still pretty low. They're yielding north of 4%. So I mean, why not, right? Especially when we talked about this earlier, they've been paying dividends since the late 1800s. So why not continue adding Canadian banks? Also added some Bill, BCE, and TELUS, T. I don't know if you two know, but we Canadians pay probably some of the most expensive data rate in the world. I was in when we usually go to Denmark, we get a prepaid SIM, and that usually comes at like, a few gig of data for less than $20 Canadian, and here we are paying an arm and a leg, probably $50, $100 a month on data. That's unheard of, right? I was actually in Taiwan in September, and got a local SIM because I had to quarantine for 4 days, and they wanted to track me. So I got a 7-day prepaid SIM, and it had all you can eat data for less than $10 Canadian. So I think it makes sense to invest in telecommunication companies in Canada because they make so much
Nice
money.
one. Nice.
Yeah, and then what else is on my shopping list? I have an article coming up, but I'm looking at Apple just because the stock share has come down quite a bit in the last few months, and you know, maybe like the likes of some of the consumer discretionary like McDonald's, Costco. I like Costco a lot. Every time we go to Costco warehouse is jam packed, and it has a very different business model than the likes of say Walmart or Target. Right? They're not trying to make margin from stuff they sell. They're making money from all the different membership. Right? So that's like high margin. So yeah, those are kind of the stocks I've been looking at.
That's a lot of money and a lot of stocks at the same time. So you must have been busy hitting that buy button the whole month, or the first 2 weeks actually.
I was not happy to see the stock market keeps going up. It's too green. I wanted to stay red so we could get more stuff at a discount, but it's what it is.
Yeah. Like you said, in a few years from now, if these are good businesses, you'll be happy.
Exactly.
Nice. Life with Dividends has asked us, on your blog, you mentioned 3 key questions to ask before making any investment. Could you elaborate on the factors you consider when evaluating to the downside on bear case, and at what point would you consider to sell a position?
So funny this lesson referred to that article. That's like one of the first articles I wrote on my blog. So for those that don't know, the 3 questions to ask before investing. The first question is, what is the upside of this investment opportunity? 2 is, what's the downside of this investment opportunity? And 3, I think that's the most important question you have to ask yourself is, can I live with the downside? So when people invest, and I definitely fall into this myself over the years and still do, to be honest, is we only look at the upside of the investment opportunity. We're like, oh, we buy Apple, it's going to be like 2 bagger, 3 bagger 5 years from now, or you buy this investment and you're convinced yourself this is going to return like tenfold or whatever, right? And it may not, but we often don't think about what's the downside of this investment opportunity. Like, can this share price go to 0? Can it return 50%, minus 50% in the next 5 years? And is that okay with you? And what happens if that happens? Like, going back to the example of ING, right? When I first bought it, went down 40-50%. Obviously, I wasn't thinking about the downside of this investment opportunity when I bought it, but that was a good learning experience. Now, the other thing, the third question, and I think, in my opinion, the most important, can I live with the downside? I think with investing, there's so much aspect of the investing is related to psychology, right? Like, can you sleep well at night knowing that your hard-earned money may be down 20, 30, 40%? What happens if you wake up and you see the market, like, think back of February, March 2020, like the market is tanking 10, 20% each day. How are you going to feel first thing in the morning when you see those red? Are you going to freak out? Or are you just like, yeah, strike it off, right? Are you going to be depressed knowing that you're losing your money, right? Like, when we were checking our portfolio, we were looking at, $20,000, $30,000 of difference every day. And it's like, ooh, like at one point, in 2020, we were down over $250,000 in our portfolio. That's $250,000. That's a lot of money, right? If you like, and luckily for us, we're like, yeah, it's just paper loss. We're not selling at this point, so we're okay with it. And I think knowing dividends are coming in, it kind of assure us a little bit, and we slept a little bit better. But if you can't live with the downside, you need to really think about whether it makes sense to invest in this stock or not, right? And most importantly, I think there's a tendency to invest with money that you need in the short term. I think I've written this multiple times on my blog and mentioned on various podcasts, is that you want to invest with money you don't need in the next at least 3 to 5 years, hopefully longer. Because if you invest with money you need in the short term, the worst case scenario is you need money, you have to sell, and the market tanks by 20, 30, 40, 50%. And you're like, oh crap, right? Like imagine you invest the money for your down payment, your house, and you just happen to find your dream home in March, like early March 2020. And you're like, oh geez, it's down 40%, but I need money, I have to sell.
Yeah.
And you're just kicking yourself at that point, right? So it's always thinking about the long term, and then think about these 3 questions when you invest. I think that's very important.
I think that they are 3 really good questions. The issue or the problem I see is that I think people overestimate the risk that they can take because it hasn't happened yet, and I think it's easy to say, oh yes, I can accept the 50% loss. And
Exactly.
I know this from personal experience, that before I started investing, I tried some trading and all sorts, and I was successful in some parts of trading, but then when I moved to the financial markets, I thought I could accept that risk. I knew the risk going in there, but it's not until it happened that I realized, do you know what, maybe this risk is a bit too much. So
it's easy to talk about theories and how you would feel, but until it actually happens to you, you really don't know what you're going to react, right?
Exactly. Yeah.
You could plan, you could do lots of plan, run a lot of scenario and all that stuff, but until it happens, you don't know how you're going to react.
On the other end, if my portfolio would go to zero, because from non-investors, that's always what they say, oh, you can lose all your money. My portfolio would go to zero if the companies that I have, I think we are having other problems in the world.
Exactly. Like if the likes of Apple going to zero, or or the
Unilever,
like if the 5 big Canadian banks go bankrupt and the share price goes zero, man, like we're in a lot of trouble in Canada, right? Like I can't even imagine that happening, because the government would bail out these banks beforehand, right?
I think Uncle Warren will step in and say, what, give me the 5 big banks, and he gets filthy rich.
That is not going to happen ever, I think.
Dazzy Mike has asked the question. He's also an engineer, and he is Taiwanese and Canadian as well. He's just looking at the current tensions in China and Taiwan. First of all, do you think US are doing the right thing under semiconductor war? And secondly, how does this affect you as an investor?
Yeah, interesting question, especially what's going on with Ukraine and Russia. I think when I was in Taiwan in September, I actually had quite a bit of discussion with my coworkers on this specific topic, and it was quite interesting getting their feedback, because obviously they live in Taiwan and had to live through the whatever missile exercises and all those military exercises. My view is, obviously there are tensions between China and Taiwan. That's been going on for decades. And that tension has maybe intensified over the last few years. But in my opinion, it might be a little bit overplayed in the media as well. I do think US is doing the right thing in terms of saying that they will protect Taiwan if something happens. I think it's in most countries' best interest to do that. And Dazzy Mikey kind of referred to the semiconductor world. That's a very, very key reference. Now, during COVID, and we're just getting kind of the the end of it. Remember, you probably hear about supply constraint, right? Like,
Yeah.
cars you can't get cars, used cars are expensive, you can't get laptops. Even if you buy a car, they may only give you one key fob because they couldn't make multiple key fobs because there's just not enough chips available. Taiwan, the Taiwanese semiconductor company, TSMC, they make something like, don't quote me on the number, but I think it's somewhere around 80% of all these chips are made there in Taiwan. So your Apple iPhone, your Android phones, your laptops, like Qualcomm uses them, Apple uses them, AMD uses them, bunch of companies use them. If you think the supply constraint was an issue during early COVID time, just wait till there's a war between China and Taiwan. Like, man, your crappy car will be like probably triple or quadruple in price because there's no supply available, right? So I think it's in these countries' best interest to protect Taiwan. And I'm hoping there's not going to be a war for obvious reasons. But yeah, I don't know what's going to happen. But for me, I don't think it's something we have to worry as an investor. I think obviously there's some dangers of not getting enough chips if something were to happen. But that's not something we could do, right? It's kind of outside of our control. I think as investors, we need to remember there are things that outside our control and things that we could control. The things we could control, we need to make sure we could control them, right? Meaning like how much money you invest, whether you buy or sell stocks on a whim. Like if the market's down, don't just sell all of a sudden, right? I knew people that sold at the bottom of the market in 2020 because they were like, it's going to go down even more. And then they didn't buy back until like September of 2020 when the market was like already up like 60-70%. And I'm just like, oh, and the funny thing is some of these people were doing like 60% stocks, 40% bonds. And then during that time when the market was going down, they were selling bonds and then buying stocks, which was the right idea. But then they just started, they then started selling stocks as well. And then they went all cash in like March 2020. I'm just like, oh man, that's going to hurt, right? So again, like I said, control things you could control, but there are things like how is Apple going to make billions of dollars? Yes, but how much are you going to make? You can't control that, right? So control things you can control, and there's always political tensions and news and stuff. So try not to worry too much, right?
And that's also where diversification helps.
Exactly.
Good. I think this is a question for me, guys, and that's from Wolf of Harcourt Street, and he's asking if we have any thoughts on LiveChat, which is a Polish company, highly profitable, with high growth rates. So no surprise that our Irish friend is interested in it. Look, it is correct, right? The dividend growth rate has been really stellar compared to, let's say, 8-9 years ago. It went up from, I think, 37 groszy to 4 zloty and 40 groszy. So that's more like 12-13 fold. I just struggle a little bit with the business model with LiveChat. I understand let's say the business they are in, right? But what I struggle with just is that I don't have enough feeling for this kind of part of technology that this is sustainable business in the next 10 years. And even with open, I said Chat GPT and everything, I just don't have enough conviction in a stock like this. If I go for tech, I usually like to go for blue chip tech stocks in my dividend portfolio and not for the niche players. And that's why I'm not interested in it, although their dividend growth rate looks stellar, their business is on fire. In the end, it's a niche play, and I don't need that in my portfolio.
Right. I can't say I know the company at all, but just hearing what you said, I think if it's very, very niche, there's always a danger of, one, somebody could come out with a similar product and taking over, right? Like a big company could just all of a sudden decide to get into that sector, build something similar, and that's
So
the end of that company, right?
They're in the business, let's say, of customer interaction automation, let's say it like that.
Right.
So live chats, chatbots, help desk ticketing systems for managing emails and such, and having knowledge bases for when you're in contact centers and such. So of course, if you can automate this, you're really saving money for the companies. But again, it's still a niche for me. I think now natural language processing and such, if we see what ChatGPT did, OpenAI, they can build probably like layers on top of that. But I just don't see that these kinds of businesses have a strong moat. And maybe I'm wrong there, but it's for me not enough to start having a deeper dive into this business.
Yeah, I think I generally agree with, if you want to buy tech companies, going with the big players, because it's I think there's just less risk, especially with the high tech, like in high tech, right? Like the Microsoft, the Apple, the Cisco of the world, they're going to be there for a long time. There's no danger of all of a sudden, they disappear or somebody taking over them. It's going to be pretty tough, right? So there's that. With the way high tech work and tech companies, like, things will change very fast, but the smaller players are usually that kind of suffer if something changes, and kind of putting yourself in a very specific niche, that's kind of dangerous as well.
Okay. Dividend Gardner has asked you, Bob, what do you think of Severia as a dividend growth investment? I think this ticker symbol is SIS.
We don't own it. I have written about it before. Like I think I listed Severia as one of the best Canadian monthly dividend stocks. Again, it's I mean, we currently own 49 different individual dividend stocks, and I will be the first one to tell you that's maybe a little bit too many. My goal this year is to reduce it to about 45. Ideally, we want to own somewhere between 30 and 40, but there's just so many companies out there that are so solid, like, it's really difficult, right? I think it's an interesting segment. Severia is a global leader in accessibility, right? So they're manufacturing products and modifications such as stair lifts and wheelchair conversion kits. And as the population age, and we talked about this, like funeral homes earlier, that this business models make sense to me in my head. Like, obviously, as people get older, they need to be able to move around. So, these kind of things. But again, it's such a niche area. I don't know if I'll invest them over some bigger companies, right? And this is where you kind of have to pick and choose, right? Maybe if you decide to invest in Severia, you invest maybe like 1% of your portfolio. You don't put all your money in this particular company, because I think there are other company that might be better. But if you want to bet on this company doing well in the next 5-10 years, you could invest in a small amount of money and see how that does, right? But yeah, like we currently don't own this company, and no plan on owning it, but I've written about it. I think it's a solid company, just depending on your investment strategy.
Yeah. Everyone loves the monthly dividend payer as well, don't they?
Yeah, but I think I don't know what's the fantasy about monthly dividend payers. Like, I get the idea of it's a stable monthly dividend income, but I mean, there's nothing wrong with every quarter. Like, I don't know. I think there's
annual.
nothing wrong.
or annual like in Europe.
Right.
Most of
There's
them they pay
nothing wrong
annually.
with as long as you get the dividends. Who cares if it's annual or quarterly or every half year or monthly? As long as you get the money, sure. Maybe you like I get it. Maybe from a expense planning, income expense planning point of view, it would be nice to have a stable income each month so you could spend what you get. But that's no different than, say, you do a 4% withdrawal when you retire. You don't withdraw 4% every month. Usually you take a big chunk of money and then you allocate how much money you would spend each month, right? So it's no different than having a dividend start paying once a year on dividends. Just you just need to plan it accordingly, in my opinion.
It's all part of that psychology that you were talking
Exactly.
about earlier. It's all. I suppose if you're planning, if you're living off income, it's probably easier to have a monthly paying stock than quarterly or as we have in
For sure.
Europe annually.
Yeah.
Okay. The last email then, last question came in by email from Erwin, one of our Dutch listeners, and the question he has asked is: so suppose he buys a stock for €10 and the dividend is €1. So his yield on cost is 10%, which is pretty easy.
Mhm.
The next year, the dividend is flat, it stays the same. Is his yield on cost still 10%? He argues that it is now 11% because he's received that €1 in dividend.
No, it will still be 10%. Your yield cost is it's per year. It's not like if using his argument, that means if I had invested a stock in 10 years, my yield on cost would be way over 100% because I collect all these dividends over the years, right? A yield on cost is just at this it's kind of looking into the past. It's like, well, at the current time, if the company is paying €1 in dividends and you purchased, say, 10 years ago at $2, what's the equivalent yield on cost, right? And when I started, I focused a lot on yield on cost, this particular parameter, but it's a nice pat on your back parameter, in my opinion. I don't think it really matters all that much. It just tells you whether the stock you invested is doing well or not, right? So if your yield on cost is really, really high, that could mean a couple of things. One is the company, the share price has increased significantly. And two, the company has continued growing its dividends. That's how you have very, very high yield on cost. If your yield on cost is lower than the current yield, that just means the share price has dropped and you're in the red, right?
Yeah,
so it doesn't really mean a whole lot, in my opinion.
I think for me, yield on cost is mainly important at the time of the purchase.
Exactly.
But it is a nice metric to track, indeed, just to see, like, more from a performance point of view. And I guess the only time when you can say that the yield would have gone up a little bit, the yield on cost would have gone up if you would have reinvested all those dividends and would look at the net yield on cost, let's say the absolute dividend that you, for instance, got, but the yield on cost, like how it's meant to be here, it would always be 10% just. Yeah, so I can imagine if you increase your share count,
your yield on cost doesn't change because that's the yield at the moment that you purchase the stock.
Exactly.
That would never change, right? So in my portfolio spreadsheet, we do track yield on cost, and not just like a fun parameter to look at it, right? So I mean, some of these stocks that we own are like, north of 10% yield on cost, but does that really matter to me? No, that just means that the stock is doing really well.
The dividend growth matters, and I sometimes would like to see my stocks when I calculate, because of my retirement fire plan, let's say. I generally often ask myself how many years will it take for this company to get to 10% yield on my investment price, and that's an interesting metric for me, because then I can see, okay, a 1.5% with 10% growth. will take maybe 20 years to get to the same stage as my 6%er with 6% growth, right? Or 5% growth. So
Yeah, for sure.
interesting. Good. I think we came to the end of the show, right? With with the last question.
Yeah, it's been fun. It's actually longer than I anticipated, but it's been this really good discussion. It's always fun talking about dividends.
I agree. It's always fun to talk about dividends. Sometimes time just flies. We find ourselves in the beginning, we thought we'd keep podcasts to about 30 minutes, and it's never been the case. It's always an hour and a half, maybe 2 hours. So this is quite normal actually for them to be this long. But it's been a pleasure having you on the show. I think listening to your journey, where you are, and some of the insights you're given, pretty knowledgeable. So we appreciate you taking the time and spending two hours of your life chatting to us. So thanks very much for that.
Thank you very much for having me on the podcast. Appreciate that.
And Bob, we will for the listeners also, we'll put your blog article, your blog linked in the description of this podcast. So if you're interested, definitely give him a visit. We'll also put your social media links on there so that people can follow you, are interesting to continue to engage with you. And maybe we'll also pick 1 or 2 of those articles out that you referred to, Bob, and also put them here in the link to the description, because our listeners are often very interested to read up on what we've been mentioning. So I'll make sure that everything is as much as possible in there. I think we'll not be able to put all the tickers in today that would be that we discussed. That would be a bit too much. So please bear with us on that one. But yeah, thank you so much. Thank you so much. It was really awesome.
You're very welcome. It's been fun.
Good. So to everyone then, thanks for staying with us. And I hope, because maybe for you, many people listen us while running. So I hope they got a decent amount of kilometers in today. So and to everyone, see you next week.
See you all soon. Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just 2 guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.